Good afternoon. Hi, everybody. How is the sound? All good? 10 out of 10? Hi, everyone. Good to see a lot of the names out there. There are still some people I'm meeting for the first time and hearing from by email. I've been backing around for, what, about 6 weeks now, I think. Um, Somewhere in that area. I think the room's open 5 weeks and still reaching out to some people. But welcome, everybody. This is Paul Lang, and I am at my own company now, Discipline Trading Strategies. And if you haven't heard from me before today, come check out the website, say hi if you want to. These events that I'm going to do every couple of weeks, these are intended to be good educational events. No hype, no tricks. I just want to relay some good information. Naturally, I think most of you know that the intent is not to try to teach you, everything that I would teach in a class in 45 minutes or an hour. But I don't hold back what I'm teaching. I try to give you, good information, and my goal is to kind of show off what there is to actually be known and understood from technical analysis. I know a lot of you have been around a while. Some of you are newer, but welcome wherever you're from. Every 2 or 3 weeks, I'm going to do one of these on different topics, ranging different things to talk about and different levels of interest for all of you. If you are here, you're on the main list, and you don't have to worry. You don't have to keep registering for these. People who are members will automatically get login information to these. I will send an email to a bigger group of people encouraging them to sign up to be a free member. And if you're a free member, you get invited to these events. You're getting a letter every Sunday, a free letter, and you initially had a trial to the letter. So I'm going to just go through the presentation tonight. And when I'm done, anybody wants to hang around, I'll take a couple minutes and answer some questions or talk about whatever I'm doing at DTS. I don't want to take up your time with that unless you're interested. If you are interested, that's great. I've been told I'm a good trader but a terrible salesperson. That's fine with me. I don't do sales. I don't do specials. I'm kind of like, when you are ready, you want to take something or be in the room, come see me. Until then, feel free to show up to these and learn what you can. I know a lot of you are in different stages of what you're doing. Some of you are working other jobs. Some of you are getting prepared to trade. Some of you have tried and maybe thinking about coming back to it, whatever it may be. But I'm here for you, and trying to help out the people who come to my room or take a seminar. I'm committed to trying to help them to be successful, whatever it takes. Any other opening comments? I don't think so, right? Yeah, so let's run through this. I do want to get done in 1 hour all the time. No, sound should be good. I have a headset on. I should be good. I can turn the mic up just a hair without burning out here. Okay, that should do it, and then adjust your volume after that. I should be good. Um, I'm going to get through this in an hour. It's 3 minutes after right now. I'm going to get through this in an hour. Like I said, during the last 5 minutes, I'll announce I'm done, and then I'll tell you about. I want to tell you about the trading day I had today. Worst day I've had since spring. Not the right backdrop to do a presentation tonight, but hey, that's okay. The room is doing really well. I'll show you the results from the room if you didn't get them in an email. And talk about whatever he wants to talk about. This Saturday I'm doing a class, and if we want to talk about that, we can. Are they going to be at this time now or at 11? Generally, they're going to be in the evening. Generally, I'm going to pick 5:30. I think most people prefer 5:30 to 4:15 because there's some people who are doing other jobs. No, well, that was something for the room people, Reg. That was not the free events I'm doing for the public. That was stuff I did for the room. People in the room, sometimes I lecture at 11 o'clock. Yeah, but that's something different. Okay. So with that, let's begin. The only two times you have an edge, and I may be stretching things semantically here, but I'm saying that every strategy, play, concept is a derivative of one of these two things. So let's take a look at what I have to say here. Here's what we're going to talk about tonight over the next hour. The concept of a random walk, what our job is as traders slash investors. I don't really distinguish. It's just a matter of time frame to me. You can call yourself an investor if you are involved in longer term time frames, or a trader. To me, the only difference is just simply how you decide to enter and exit plays, or the duration you're holding them. I use the terms interchangeably. You could be a trader who holds things for 6 months. That's fine. What our job is, pre-canned concepts are of limited value. I want to talk about that, one of my kind of pet peeves that I think ends up hurting a lot of traders. I want to talk about what the first edge is. I want to talk about what the second edge is. And then if you are not aware of this, what are you doing? And give some examples along the way of what I'm talking about. Question for all of you to get you off your hands and to typing for a quick minute here. Is the market a random walk? You know, there's a lot of talk about random walk, meaning that it's been proven that it's just completely random price movement, unpredictable, etc. Is the market a random walk? What do you think? Yes or no? Give me some Y's or N's on the screen. You don't have to vote if you don't want, but anybody who's not on their hands, is the market a random walk? What do you think? Let me get at least a couple dozen answers. There's a lot of you here. Got a lot of no's. Got one T, I assume that means yes. A lot of no's. A lot of no's. I'm not sure. I'm not 100% sure if that is your answer or you're trying to please the teacher. But my answer, gun to my head, one answer, I'd probably have to say yes. The market, for the most part, is a random walk. Price action, stocks, market, for the most part, it's a random walk. And I'll explain what I mean. Because I think it's very important that you understand at least what I mean. And again, a lot of this in my mind comes down to semantics, just what you're saying. But I think for somebody who feels that they can understand the rationale technically and or fundamentally for every move is going to have a difficult time trading or investing. For the most part, I think not understanding this concept is the downfall of many traders. Trying to make something out of nothing is what it can amount to sometimes. Feeling compelled to know or explain every move can lead to confusion and the lack of confidence. And you're hearing this from me. I'm open to other interpretations, but you're here to kind of hear what I think about this. Let me tell you how I discovered this, and some of you may have heard this story, and if you have, forgive me. Just grab a cup of coffee or something. I'll take about 2 minutes. The reason I discovered it, it was kind of my end of first year of trading. I was doing really well at the time. The reason there's two joggers on the screen is because I lived somewhere else at the time, and my next door neighbor would come over every morning at 6:25 and knock on the door, and we'd go running together in the morning. And he didn't really know what I did. He just didn't understand the market at all. He had stock in a company that he worked for, and really didn't understand what I did. I had something to do with the stock market, and that was it. Well, after we'd been running for a few months, he stops me one day before, when we're done, and he says, "Hey, I want you to look at something for me." He said, "I worked for Allstate, for many, many years before I'm doing what I'm doing now." And he said all his holdings, all his stock, his whole mutual fund, his whole upcoming retirement is all in Allstate stock, right? So he said, "Could you tell me what you think of Allstate? Am I safe doing this right now?" Okay. So I went, to my charts that night and remembered him in Allstate, and I looked at Allstate and I pulled up, he's talking big picture, so I pull up a daily chart, a weekly chart, a monthly chart. I pulled up the daily chart again, the weekly chart again, monthly chart. Yes, there's a video replay. And after looking at all those charts, then I started to stand on my head and turn the computer upside down, turn the monitor upside down, and I started to sweat a little bit and look around and get a sick feeling in my stomach. Do you know why I was not feeling well? Do you know why I was not feeling all that well about looking at Allstate? You might take a guess? Yeah, Reg, you're exactly right. Because I was a self-proclaimed expert on charts, and I looked at this chart forever, and I didn't know what to tell him. I mean, I just didn't know. I was like, okay, well, I could tell you maybe if it did this and this, it's kind of bullish. If it did this or this, it's kind of bearish. And it was really kind of frustrating. Yeah, because you've heard the story. Okay. Like I said, my apologies. And it took me a while. I didn't get it that night. Actually, it kind of made me sad. I was thinking, boy, here I'm supposed to be good at this, and I was actually making good money. And yet, a guy asked me a simple question: "Is this stock bullish or bearish?" I don't know what to say. And that's when it struck me. It was over the next month or two that it struck me exactly what the problem was. And the problem is that when I go to trade, I'm not given one stock, Allstate. You want to go long or short? That's not the option I'm given. I'm given the option of looking at dozens, hundreds of stocks, and or if I'm playing the market, I get the option of looking at the market on many different time entry possibilities. This morning, this afternoon, today at 10, tomorrow at 12, different types of ways to play the market. There's a lot of different opportunities. In other words, the point is, what I learned is that our goal is not to try and understand everything out there. Our goal is to find specific patterns that jump out and stick out for us that make them tradable events, where we have what we call odds, or what I'm going to call in a minute an edge. Does that make sense to everybody? Does that hit home with any of you who haven't heard this story before? To me, it's one of the biggest things you can learn. And on one hand, you may say it's kind of a simple thing. On the other hand, if you haven't really encountered this question before, it's really critical, because it's critical in terms of what you try to do in the market. Your goal is not to go out and try to conquer everything in the world that's out there. As a trader investor, our job is to understand that most price action is random. Where did I get 97%? I scan 1,000 stocks every night, and 97% of them I don't care about. So therefore, I came up with the stat, and as you all know, 96% of all statistics are made up on the spot, like that last one. But seriously, I mean, the vast majority of chart patterns I look at, I just don't care. I mean, if you put a gun to my head, I could tell you things about them. If it did this, it might do that. The trend it's in, but I wouldn't say, okay, I want to take a trade in this. So the vast majority of patterns we have to realize are things we just want to say, next pattern. Now, naturally, if you play the market, you can't say next pattern too much, because there's, one market, or maybe you look at two or three markets, so to speak. But you do have multiple opportunities of when to get in, when not to get in. You don't have to trade tomorrow morning at 9:31. You don't have to trade tomorrow morning at noon. And this is the big advantage we have. If you ignore this concept, our job as a trader investor is to understand that most price action is random, and to ignore this random action. Don't try to make something out of it. Our job is to find instances where the price pattern is screaming at us when price cannot hide the fact that there are big buyers or sellers. And for those of you that are very visual, I am getting some charts very soon. We'll get the typing off the screen in just a couple of minutes. Therefore, the success is a matter of timing things so the reward to risk makes sense, or those occasional times that we get interested at the end of a big move by buyers or sellers. In other words, what I'm saying is that's our job, is to find these glaring price patterns where buyers and sellers cannot hide themselves. And if we find these, the only way we can screw it up is by timing it wrong, because we don't know the exact moment things may rally or pull back a little bit. That's actually what I did today that made for a bad day for me. And it's also possible that, we wait too long and we start to play a bullish move at the end of the bullish move, and we miss it. And that, of course, should never happen, but that's the only way you can really mess up if you follow this concept. Our job is to ride the coattails of big money moves. And it's probably a cliche saying you hear sometimes, but it really is what we want to do. We're not out trying to make the pattern. There's somebody else making the pattern. We don't care why they're making it. We don't care if they're right or if they're wrong. They're right. If they move the stock $2 today and we're a day trader, they're right, and we follow them. If big money on a swing trade can move a stock, several dollars higher, and we can take that ride, that's what we want to do. Whether or not we felt it was justified, not justified, it doesn't matter. That's what we're trying to do, and that's what we do by following price action. We follow what is actually happening to prices, not what we think should be happening, not what other people tell us is happening, but what is actually happening. It's simple, but it eludes a lot of people. What is that called? Number 3 on the prior slide, it says to find specific instances where the price pattern is screaming at us when price cannot hide the fact that there are big buyers or sellers. That's a phrase I made up that I like a lot. When price cannot hide the fact that there are big buyers or sellers. What do we call that? We call that strategy. It's a strategy. It's a set of circumstances we look for that say, hey, I know this set of circumstances. I know that when this happens, it's going to lead to this. That's what we call a strategy. Because we have to find the criteria where we know there are good odds of a prior situation repeating itself. And having a strategy that is definable and reproducible with high odds is what gives us traders or investors an edge. There's the definition of edge. I looked at Webster's and they didn't even have the right definition of edge anywhere. Maybe I didn't look far enough. Just talk about the end of a table and that kind of stuff. But edge is an advantage that makes someone or something more successful than other people or things. That's what we're looking for. Now, before I get into the title tonight, or the two edges that I feel that the market gives us, the only two that it gives us, the only two times you should be acting, there are a pitfall area, and it's called pre-canned strategies. Now, what's a pre-canned strategy? Well, you probably don't know because I made up that term. What it means are these cookie cutter patterns that you hear all the time, okay? And again, don't get me wrong, they're not irrelevant patterns, but they're dangerous. And let me ask you, somebody, while I show you these, tell me why I think these are dangerous. I'm talking about head and shoulders pattern, cup and handle, double tops and double bottoms, triangles, flags, pennants. Why are they dangerous? Anybody have and some of you probably have been frustrated with these because maybe you read a book or something and they explain these and they just don't seem to work. I mean, yeah, conceptually it makes sense. What's the problem with them? Because everybody uses them. Okay, everyone expects them to play out the same. Okay, that's close there, Reg. They do not work all the time. You see, expect stuff that's not really there. It limits our awareness. Okay. All right, well, those are all good answers. But see, what I mean by cookie cutter is you're looking at these patterns in like a vacuum. You know what I mean? You're just saying, here's a bunch of bars, and when these bunch of bars do this or that, here's what's going to happen next all the time. But it's really missing the bigger concept, which is where is this stuff happening? Head and shoulders pattern, okay, that's a reversal. Well, maybe it is, maybe it's not. I mean, what if this is in a massive downtrend that just started, had a terrible gap, massive downtrend, and maybe on this time frame, you're breaking the downtrend temporarily just so that the bigger time frame now takes over and you're falling. In other words, all these things happen in an area, and you have to understand the big picture of what's going on, the puzzle pieces where they fit, and then these all come in kind of like as the glue that holds the puzzle together. Does that make sense? I just made that up the minute I said it. I never said that before, but it's kind of like the glue that holds the puzzle pieces together. And some of these are not even accurate things. Like a double bottom or double top, that's not even a tradable event. That's not even a strategy. People talk about it. It's only useful to look backwards at a chart and say, okay, that was a double bottom or double top. Because in real time, right, you can't trade a double bottom, correct? You know what I mean by that? You can't trade. I'll show you real quick what I mean. Right? You're in a downtrend. Boom, you're falling. Golden rule of trading. You're in a downtrend, always stay short. And what happens here? All of a sudden we hit this prior low and we start to bounce a little bit. When is that a double bottom? Anybody who likes double bottom, when is it a double bottom? As soon as I go up a penny? A nickel? A dime? I mean, but it doesn't matter because you'll always get that little bounce, a little micro bounce, but then you keep it lower because we're in a downtrend. So you're supposed to go lower. It's not till you're way up here that you look back and say, oh, double bottom. And this is the problem with these prior bars. On what time frame, Glenn? No? You're on an hourly chart, you're above a 1 minute. I mean, what if it's a little tiny bar? I mean, it just doesn't matter. When is a higher low formed though, Ray? When do you call that a higher low? When it's a nickel higher? You know what I mean? It's undefined, in other words. And the problem with these patterns is that it's like a reverse engineering process. Somebody teaching you that says, look, we're up here. Go back and look what caused this. It's a double bottom. Wow. Is that cool? But then when you go to do it, it's like every one of these was a double bottom, right? Every one along the way. These were all double bottoms at one point, right? They were all double bottoms. How was that one the special one? And believe me, I've been through, I've been around a long time, and I've seen technical analysis from the simple to the extreme to the complex. And your goal is to eventually make your concepts simple. But in order to understand what simple is, you first have to understand everything out there. I know that sounds weird, but it's like almost anything. The experts who make things look simple can do so because they understand every concept involved in the field, and they say, okay, here's what you do. You know what I'm saying, everybody? So initially, you have to learn all this stuff because you have to learn how deadly some of these, cookie cut patterns can really be because they just don't work like they are. They're taught by the concept of reverse engineering, to just kind of say, well, here's the pattern that worked, right? And then we go backwards and find why it worked. But that's not how it works. That's not how, because you're ignoring all the times it didn't work. And it's true with any strategy you do. You have to go and you have to really understand. Yes, all strategies will fail sometimes, but we want the high odds ones that work most of the time. So these pre-canned concepts to me are one of the negative factors that prevent traders from really understanding what's real out there and to understand the language of charts and to understand that basically most of the things you're going to do are revolve around one of these two things I'm going to talk about today, which I haven't even gotten to yet, right? Read your comments real quick. We're caught up? Okay, we're good. All right? So hopefully that makes some sense. If it doesn't, hopefully it will at some point in the near future, because if you start off and you're trying to learn some of these things, it's just a very difficult road what to do. And even any one of these, I wouldn't trust. Even the concepts I teach, most of them I don't trust initially. I want some confirmation of some kind because nothing is that reliable. A few things are reliable. So if you look at all these, all of these have little value, and looked in a vacuum, you've probably discovered this. I'll show you examples in a minute. I just showed you the examples on the whiteboard there I wanted to show you. So the first edge. Now when I show you the first edge, don't don't say, oh gosh, what a boring thing. This is one of these things you go full circle on. It's one of the first rules you learn as a trader. And after you learn it as a trader, you kind of say, oh, you kind of forget about it. And then in later years, when you really start to understand what really works well, you come full circle back to this. And it is very simply a trend. And I know this is like kind of basic. This is one of the few sayings you learn when you start off that actually is true. There's so many sayings you'll learn that aren't true, that hurt you. The trend is your friend really is one of them. And I know it's a simple, basic concept. But when you think about it, most of the strategies that you are going to eventually play revolve around the trend is what you're doing, because the trend is one of the times you have odds. Examples. You want an example? You know what I didn't put in here? I meant to put a chart of the market in here. Look at a weekly chart of the SPY. Right? For pivot after pivot after pivot after pivot, everybody, it has to break, it has to break. Market's extended, market's extended. If you just always base, whenever there's indecision, you base your trading decision on the fact that the trend will win whatever war is going on, and you'll be on the right side of the trade the vast majority of the time. As a matter of fact, like if you look at the SPY weekly chart, you still would never be wrong. For 10 years, you would never be wrong. Someday you will be. So you're right for 10 years and you're wrong 1 week. But that's what you have to do. The people who are constantly saying this is the top, this is the top, they're fools. I mean, they really are. So we follow trends, and most patterns that you play revolve around some form or another. If you play breakouts or you play pullbacks, it all revolves around the trend. That's what the quality really comes from. That's where the power of the pattern comes from. So many strategies are derivative playing the trend. Many people lose the forest for the trees and forget why they're trading something. And again, that's where I talk about people get all hung up on a specific little strategy, whether it's a breakout or whether it's any one of the patterns we just talked about. And by the way, none of those I actually teach as a viable concept. Whatever it is that you do, sometimes we get all hung up on what I would call the entry to something, and we forget where we're playing it or why we're playing it. And sometimes you look back at what you're doing, and all of a sudden you find yourself trying to go long in a downtrend, just breaking one of the basic tenets of trading, and it doesn't work, and you don't realize what you're doing at the moment because you got caught up in a little micro strategy rather than the big concept of what's going on. There's some mathematical precision that can be evaluated when you study trends. And one of the simple things that you just learn to read, and it's when you're uptrending, there's always selling going on, right? But it's this casual, controlled selling, because what it is It's people who are making money on the way up who are taking partial profits. And maybe half the people are taking all their profits, all the people are taking half their profits, somewhere in between there. And sometimes you get a little more selling, sometimes you stall because you sold too much, sometimes you get a little more selling. And people overreact all the time to, oh my gosh, that was more than 50%, and oh my gosh, we didn't make a new high. And they try and overread all the time into the chart that, holy cow, it's going to end. There are signs when a trend is going to end, but you have to understand a lot of times when you don't make a new high, it was never expected. You shouldn't have expected it. Sometimes you pull back further than you should have. There's reasons you do. And you can read all these on a chart. Naturally, these are things that take a lot of understanding I can't go into tonight. But trend analysis is really critical, is what I'm saying. And understanding the imperfections of a trend, whether they matter or not. Many times they don't matter. People get all hung up on, holy cow, the trend's not acting like it should. Well, very few trends are perfect the whole time. The SPY weekly chart pretty much is perfect the whole time, but very few times it's perfect the entire time. And you have to know when there's a difference. And what we want to look out for is when the people who are buying are now net sellers. That's what we want to see the change in, and recognize when that actually is a change and when it is just a little hiccup in the pattern. This is an understanding that we have to have. And so what I'm saying is that understanding trends is more than just the basic textbook, all we're heading up, all we're heading down. We need to understand when they really are breaking, when they're transitioning, when it's just a stall, when we should not expect a new high. All the time I see, in the room, people will say, well, that last rally, let me redraw this real quick here. That last rally didn't make a new high, therefore this stock is done. And it's a pattern like this, and it does that. And I say, no, the pattern's not done at all. I mean, you get a separation of the moving average, you get some acceleration, and the stock is simply just not going to have the power to make a new high. It doesn't mean it's going to fall. It just means it leaves more resting time is all it is. So you need to, there's a lot of little nuances like that you have to try to understand to play trends. But finding perfect trends is one of the basic strategies that you should always be all about. And let me show you an example. This was Friday. This is the last pure trend play that I did. And I think this was Thursday maybe. And the stock was BABA. Now I come to the market every day. I scan 1,000 stocks looking for one thing. Precise patterns that I would know and would think would translate either to swing trades possibly or for intraday plays that next day. And one of the things I want to see is a really nice daily, hourly chart pattern. BABA had this one day last week. And because of the precision of this uptrend, that this day I was willing to play that pullback right off the low. This is an hourly chart, and you can see a little arrow there. And this is the play early in the room that I did. And this is based 100% on the trend of BABA at the time. The daily chart / hourly chart. Understanding it gave me the confidence. Here's the 5-minute chart to come in here and play this right off the low. Really what you would call no strategy on the entry other than this stock is going higher. Now, because of the great entry, this stock ended up making like 1R. It made a little better than 1R. It wasn't ever a great play. But without that great entry, it would have never made any money at all. And this is just simply playing a trend, just a powerful trend, and understanding you can trust the support areas. Trends and support go hand in hand. When you lose a trend, support doesn't exist anymore. People often call support areas, areas of support when they are no longer support areas. They're just reference points. Support really only exists in uptrends, and resistance only exists in downtrends. So first edge is a trend, pretty simple. There are many examples you can see. Look at a chart of the market on a weekly chart. Look at many different time frames on things. The examples are numerous, especially right now. Right now, uptrending stocks are outnumbering downtrending stocks by a near record amount. It's even hard to find. I scan every night, and it's hard to find a good downtrending stock. I'm not saying there are several stocks that are in general heading down, but not clean patterns heading down of consistent selling. There's this very spotty, random selling that gets bought, very sloppy patterns, very hard to find quality charts heading down. Let's take a look at the second edge. Now, the second edge is almost kind of the reverse. A trend is saying, look, we have this mathematical precision. People are buying. There's some selling that comes in. People step up to buy again. We keep seeing the chart. The buying come in sooner and sooner. The selling come in later and later. The trend continues to grind higher all the time. As long as our trend analysis says nothing's changing, we trust that trend until it breaks, whatever that is, because that's what we do as a trader. We never have certainty. What's the other time where we have an edge? The other time is what we call shock value. It's when, and this one's real easy to explain because I'm going to show you an example here, but shock value is when things have suddenly changed and it has people in a certain position, kind of by the neck, let's say. Shock is when something happens quickly to traders and or investors and it immediately changes the outlook, or at least on some time frames, it should say, really, not trends. In trading, this happens from certain types of gaps, from wide range bars being ignored, or quick happening failure patterns. Those are the ones that really create some kind of shock value. You could also call it just a failed expectation of what's going to happen. People look at charts, they look at patterns, they look at prices, they have certain positions, there's a certain expectation, and all of a sudden, all of that changes. Just boom, it all changes. And that leads to a very predictable outcome. Let me show you what I mean. Well, out of these, which, I saw I was stalling because that wasn't on the screen, which is the most powerful? Do you guys tell me, out of those four things up there, which is the most powerful form of shock value? There is definitely a right answer. Certain gaps, wide range bars ignored, quick happening failure patterns. Yeah, you guys have it. It's certain gaps. Certain gaps. Stocks gap when they open at a significantly different price from which they close. That's what a gap means. It means you only see a gap on a daily chart or on the intraday charts at the daybreak at 9:30. There's no such thing as a stock gapping during the trading day. I mean, it's not a strategy. If it happens, it's because it's halted or because it's extremely thin. But stocks gapping create a tremendous effect for us. They gap because some kind of news came out when the market was closed. It could be earnings, it could have been guidance, it could be some disaster that happened. It could have been news on the company, the sector, or the whole stock market, or the world. It could have been management changes. But we really don't care what the news is, and I'll explain why. We really don't care what the news is. Why is this so powerful? Why is this so powerful about gapping stocks causing shock value? Anybody have the key word? There's one key word. Why is this so powerful? Stock gaps. And I'm saying that sometimes when you know the pattern, it creates a very predictable, powerful move. Yeah, trapped. You said the word right there. Trapped. Because people are trapped. It doesn't matter why they are trapped. It doesn't matter why they're trapped. This is what people focus on the wrong thing sometimes. It doesn't matter why they're trapped. They're trapped. I want you to think about this. Look at this chart. Just put yourself in this poor investor spot for a minute, right? Here's a chart. You love this chart, moving higher, and you enter long swing trade, 30-cent stop. It's a $22 stock. You come in on this bar here and you say, you know what, this just broke above this prior red bar and above this wide range bar. I'm taking this as a long swing trade, 30-cent stop. I'm in, holding overnight. Boom. Okay? So you risk $1,000 with your 30-cent stop and you're good to go, waiting for this thing to make you money the next day, right? Well, there's where you entered the stock, and take a guess where it's going to open. It's going to open right there. This is a real stock, of course. This just happened. And at open, you're down $6,000. What's your first thought when you're down $6,000? Well, your first thought is probably, that's not, be honest, that's not your first thought. That's not your first thought. Come on. It's not your first thought. Yes, Patrick, you're the honest one. I hope it bounces. I hope it comes back. It's a big gap down. It's probably going to come back and I'll be fine. But here's the problem. Look at that trading day. Every second of the day, you are getting pummeled, right? And you just can't take it. And it starts a snowball effect, right? You have to sell, and when you sell, prices drop, and that next tick down is the next tick for the other traders to say, oh, I can't take it either. I got to sell, I got to sell, I got to sell. And you have this snowball effect, and it actually goes on many times for days. The people who are trapped in this pattern, and it's not just you from the day before, it's the people that thought this was the day to be long. It's the people that thought this day was the day to be long. It's people that thought this higher pivot was the day to be long. It's people that thought this is the breakout time to be long. It's all these people going back to whenever they thought the pattern was bullish that are now in this that have a problem. And the problem is a serious one. Now let me ask you something. Were you a good trader or a bad trader, good investor, bad investor to hold that? Does it even matter? In other words, don't the most cautious, great investors, aren't they going to get trapped also sometimes? What about a fund? Can a fund get trapped? Absolutely, a fund can get trapped. What if a fund gets trapped? What do they do? You realize that a fund, besides, I mean, whether or not they have quantitative programs to help them do this or whatever, there is emotion involved, and you know what? They have rules, right? They have rules. They get down a certain percentage, their bylaws state they have to get rid of the stock, right? Yeah, Patrick, they have to follow certain rules. They have no choice. So you can read into this with patterns like this. You have great odds that, and not now. Don't get me wrong. Every time a stock gaps down does not mean it's going to fall. Every time a stock gaps up does not mean it's going to rally. That's a complete fallacy. But there are, five very unique things that we look at, and when they all line up the same way, there's really good odds it's going to fall. And the only question becomes exactly when. Right at the open, 10 o'clock, 10:30, lunch. It's not always crystal clear. You can learn a lot from looking at the chart, but we're never 100% sure. And that's why we have to do two things. That's why we have to learn the right entries to help us find those times. That's why you have to use stops in case you're wrong. Because anything can happen. We play odds. So you understand from this example how you are feeling and why you're trapped. And let me ask you, when you're down 7 grand at 9:35 in the morning and it's increasing as fast as you can see your little money click or spin, do you care if this stock gapped down because they had bad earnings? Do you care if they gapped down because they had good earnings? Do you care if they gapped down because there's a management change? Do you care if they gapped down because the boss was caught in the bathroom with the secretary? Do you care about any of that stuff? Right. None of that matters. And guess what? To the fund that owns 500,000 shares, none of that matters. Right, everybody? It just doesn't matter. You don't care. It's the pain that you're in and or the rules you're following that make you exit. And then exit causes a temporary win for people who can understand what's going on. Now, what happens is at some point, all the people who, that are in trouble and had to exit, they stop exiting. And you get a little bounce back. Right? And then after the bounce back, then you get people. You get people now that didn't sell, right? You get a few dum dums that held their breath and said, "Oh my gosh, I didn't sell. I may be in a lot of trouble." Where's my pencil here? So there's people up in here that are in a lot of trouble. They sat through all this, sat praying every night for 2 weeks, and then finally they come back and they start saying, "Okay, time to get out, time to get out, time to get out." And then what happens, of course, next is that some more sunlight will come in. And then at some point, the effect of the gap is just gone. In other words, people who had to buy, had to sell, want to buy, want to sell, they've all done what they've had to do because of that gap, and the stock returns to its longer term pattern, whatever it was doing. Or whatever it's going to do now. A lot of times, the right type of gap can create a totally new pattern on the biggest time frame even. So that's what you have to learn and understand. Gaps create shock. They can make for moves the first half hour of the day and can make moves for a month. They can be great swing trading entries. As a matter of fact, I've been saying for years now that it's hard to beat a swing portfolio comprised of putting the right gapping stocks into it. It's hard to beat that. understand whenever there's a sudden movement, whether it's from a gap or for any other reason, there's four categories of people all the time. And this is why it's not so easy to just look at a chart and understand right away what's going to happen. There's people who want to buy the stock. There's people who want to sell the stock. There's people who have to buy the stock. There's people who have to sell the stock. And by looking at a chart, we can get a good sense of the balance and where that falls on a lot of gaps. Now, some gaps you look at and you say, you know what, bottom line, it's just kind of neutral. I think there's kind of equal buyers, equal sellers. I don't know which way it's going to go. Does that make sense, everybody? But what this gives us is a tremendous edge, because we can look at a chart and say, you know what, I know that thing, I know that if this or this happens, that thing is going to fly today. So most recent example for me was yesterday, a big gap. Whoops, I'm sorry, I clicked the wrong arrow there. A big gap in out. Out is the name of the stock. It's not. It's confusing when I was typing this yesterday because I'm saying, you know, out, stop to 13, whatever. And what do you mean? You're out of it? No. The stock is out. OUT. Had a large gap up yesterday. I wish I could tell you I was in this. I was not in that there. That one I wasn't looking at the open because it was not in the category of stock that I would play at the open. I played that first pullback right in there, and you can see the numbers of theirs is done in the room. And this, you know, and it's the understanding here, the type of gap that this was one that I felt once it stabilized, it would return back to the high of the day. Now, it didn't come close to doing that. It made, you know, too risky. It doubled my risk. So a $500 risk, I made about $900. I'm sorry, whoops, I didn't mean to click on that. Entries in there, stop is a 40-cent stop about, and it was right in the close. Actually, it was kind of funny because I had a target at 24.24. It literally hit it a minute in the close, or that last couple of minutes. And that was the first target, but because the market was closing, it just sold the whole thing. But so that was a gap from yesterday. Now, the most recent gap I did was today. I told you I had a bad day today. As a matter of fact, it's the first time since late spring that I shut down because I went down 3. I lost 3. Boom, boom, boom. 3 trades in a row. I double played the what was the gapper today? The Red Hat. I played Red Hat, and I played another play that was one of my favorite plays, and just nothing clicked today. So, but that was the first time since the room's been open. I've only had, I'm going to say, 5 losing days, and they were all 1-hour days, except for one was a 2-hour day, and today was a 3.5-hour day. So you just shut down and you go the next day, and all the others, were just routine days inside of good weeks. I'll show you the room in a minute, the results, because they've been very good. But today, I'm just telling you, it just happens sometimes. That's why you have stops, and that's why you miss it once in a while. And Red Hat actually turned out to be a really nice play. You saw it came all the way back to the high of the day, but I had the timing wrong today. I went after early, not wanting to miss. I thought a potential early move up, and today was the reverse of that. So I goofed it today and lost, and that's what happens sometimes. Okay. Yeah, Jim, but I'm not lots of people, and I shouldn't have had trouble. No, actually, today, ironically, I evaluate what I did. I made no mistakes today. I made no mistakes. I did what I wanted to do. There are a lot of gaps lately that have flown in the morning and gotten away from me for not being aggressive enough. So I was very aggressive with Red Hat, and actually, I don't have the chart of Red Hat here, but it flew at the morning. I was trying to get into it first thing, and it was a great trade. It flew higher that first 5 minutes. It was a great trade. I couldn't get in. It jumped 30, 40 cents at a time. It was crazy. I kind of was committed to get into it no matter what. I just couldn't do it. It just moved too fast. And then it was the first pullback that I played and replayed, and it was too early because the pullback ended up going all the way until lunch. So just what happens. So I want to show that to you. They're not all winning trades. Overall, I do incredibly well, but they're not all winning trades. As a matter of fact, if you look at my YouTube site, the last trade of the day or the last trade of the week I did featured 2 stocks, but one of them was a losing play because on that I made a mistake. I made a mistake on one of the trades, and I made an example out of it, the trade of the week. It's not all about the winning trades. As a matter of fact, I talk a lot about the fact that anybody on any given week, it's not really about having the great day. Anybody can have a great day. It's about controlling the McDonald's days, as I call them, or controlling the bad day to make sure that your week always ends up green all the time. So another example of a gap that was, this is one of my favorite trades, Matt. Again, some shock value. This is actually a combination of both of the concepts of work. Look at the day. Well, the daily chart isn't here. It's just in a bleeding daily chart. It tried to bounce through here. Here's the hourly chart. It gapped down a little bit this day, got in there and nailed this thing. Short of the top of the base. As it started to consolidate more and more, I lowered the stop. I added some shares. Got first half just off the low and then trailed the rest. It never went lower than that. That was the low of the day as it turned out that day. So that was the best it was going to do, but it ended up being like just about a 2-hour trade, a little bit under 2 hours. So gap trading is the way to really play the shock value. Take a look at just some recent examples, and these are not all plays I did. I'm just showing you examples. Some may have been, or some later in the day, or some the next day, but these are just examples, recent trades, recent plays, recent gaps, and the power that there is. Notice this is the gap we're looking at, over that big red bar down. Here, a stock that goes up for the next 2 months. Here, look at the size of this red bar. Boom. I want you to notice something. Two of these charts have something in common, and that's the huge first day move. Look at these moves. These moves are the biggest bar on the chart, and most of that move often happens the first half hour of the day. These are the type of things you look for as a gap trader. That shock value, that people that are trapped all hitting for the exits at once, causing a panic. If you're not in that panic, you can stand back and say, hey, I'm going to tag onto the coattails of these people and run this stock down with them and just take that ride down. And then there's other gaps like this where you do not expect to have a big day up the first day. This one here, the expectation was to go nowhere, but long term, it may end up going somewhere. And some of these can be played as swings a week later, 2 weeks later. This one here, the expectation was to go much higher the first day. It did. It ended up closing a little weak, but then continued higher for 2 weeks. And here's another set of charts, all different charts. Boom, 2 big days up. Boom, huge first day down, and a trend that continues on for a month. Boom. This is, I played this long. This is Finnell. I played this long this day. Again, knowing the difference, right? This stock was played long. This is Finnell. For those of you who are there, right? Somebody in the room, Finnell, F-I-N-L, long. And this was the gap over that base. I forgot what stock that was. So just the power that's there from these is something you don't find anywhere else. I mean, you go looking at regular charts during the day, you're not going to see these type of moves. So that's why a lot of people like to, and I do like to focus part of my trading on gaps. Now, not all of it by any means. As a matter of fact, I'll show you what I focus on. So if you're not doing this, the question is, what are you doing? What are your strategies? Perhaps you have a good answer. Perhaps you're making good money and you're happy. Or maybe you're doing one of these two things and you just don't really realize it because you're very focused and nobody explained it this way. Or maybe you're not sure, but the question is, are you playing random events? How do you tell? Well, look at your results. Are your results very random? Can you look at price patterns and say reliably, yes, I know what that's going to do most of the time. I'm willing to put money on it that somewhere between now and there it's going to reverse and go higher, and I'm willing to play that. Can you say that with confidence, or is it always a struggle to try and figure out what's going to happen? I practice what I preach. Every day in the room, I give a watch list at 9 o'clock to everybody in the room, and it has two things on it. Strong trends, right there. These are trends. The daily chart watches are hourly and daily chart trends, right? Trends. I'm going to write here. Trends, which is edge number 1. It's hard to write with a mouse, forgive me. Trends down here. And gaps up here. Gaps from that morning. And that's the big focus, to go through these two lists. The trends section can lead to a lot of little sub strategies, right? When you have the trend, when you have the power of the trend, there's lots of different ways to play it. Be the tail play, breakouts, a lot of different things, right? The trends are emanating from the daily and hourly chart, Terry. As an intraday trader, the hourly chart is huge. A lot of times you can have a strong 10 on a daily chart, it's good for swing trading, but it's not timed right for intraday trading. You know what I mean? You can have a nice trend going on, be 3 days up. I don't necessarily want to play it intraday. It depends what it looks like. So you got to look at both charts a little bit. But I will initially look at daily charts, and then from those look at subset, look at the hourly charts, and find one that have good combinations of both. Okay. The carry list is I don't have to explain it. That's what it is. It's charts that I want to hang on to from that day. Like in other words, maybe it's some gappers and I want to watch them for the next day. They could be very definitively bullish or bearish. They could be things for my own education. I continuously believe on improving my skills, and there's certain gaps that are not always clear to me, so I don't play them. But I want to follow them for 2, 3 days to see what they do. So that's just a miscellaneous list. I don't have to explain what's on there. It's just, hey, here's interesting stuff. Keep an eye on it. They may end up back on the daily bullish list. They may end up being taken off. Whatever. Okay. So, perfect timing. It was pretty good because I got a couple more minutes of real talk, and then. So if you're not trading, so trend, shock value, if you're not trading that, what are you trading? Think about it. That's all I'm here to tell you today. So I told you I had a terrible time in the room today, but that gives me the right now. Watch this transition. But that gives me the right now to show you how well, in general, I'm doing with the room. This I sent out last Thursday to everybody, so it does not include Friday or Monday. Friday or Monday, I was net positive just a little bit. I lost a half hour plus Friday, and I made a half hour plus, no, made over an hour yesterday. So they're pretty much in here, not counting today. But you can see the room is doing really well. I teach people you need to make your living on 1 hour a day, 20 hours a week. And I'm averaging about an hour and a half a day. And this is not like the typical, if you guys are not in the room or you haven't been in a room with me in a long, long time or forever, this is different. This is a very, playable, follow me type thing. This is not a hyper room. As a matter of fact, my fear is that I'm boring. I'm doing 2 to 4 trades a day, usually 2 or 3, and we'll go an hour sometimes without really even the notion of a trade coming up, because I'm looking and scanning and looking for the best stuff. So it's boring, but we make money. And the problem is, I know for a fact there's a lot of people that would rather be entertained even if they lose money. So, yeah, I know, Terry. I'm just talking to the rest of the people out there, a plug to come try out the room. That's all I'm doing here. So I am basically, folks, I am done with the presentation. Any questions? I'm saying that I believe, and I teach people, you need to be able to make your living from 1 hour a day. Now, you don't start off trading like that. You start off trading on paper. You start off risking $5, $10, $15 a trade. You build a track record. And when you get the confidence that you know your strategies, you know what you're doing, you start upping that slowly until you have a risk amount where one risk unit a day should be making you a living. And if you're pulling in 1.5 a day, which is what we're doing, you're just flying high and loving it. And that's where you should be. I think traders make a mistake of thinking that they are trading safer by having less risk, and they risk up, $100 a trade, and they're trying to make 6 hours a day, and then they're over trading and losing. Does that make sense to everybody? What I just said, does that ring a bell with anybody? Does that make sense? Oh, I'm not that good. Let me risk $50, $100. Oh, I got to make 6 hours a day, and oh, now I can't make that, and I'm over trading. No, take quality trades, and it can vary. I have a style of 1, 2, 3 a day. Some people, and I just trade in the morning, and some people maybe are more active. That's fine. I'm not saying you can't be more active, but I'm saying take quality trades and shoot for a realistic risk unit amount that you can make, and then assign a value to that once you're confident that makes your living. I've just seen too many people that don't do the right procedure. They never get the confidence to risk what they need to, and they struggle the whole time, because I don't think you can make 5 units a day. I mean, if you can, great, but my style doesn't do that. And for most people, I think the vast majority of people I meet, what I said makes an awful lot of sense. Okay? Patrick, open trades not more than 2 are correct. I'm not sure what that means, Patrick. Maybe you could re-ask that. Open trades not more than 2 are correct. Need to have 3. Yes, for a day trader, the SEC required amount is $25,000, and naturally you want to put more than that in because you have one losing trade, you're done. So that's an SEC rule. It's not by broker, and that's what you need to day trade stocks. That's correct. If you're doing futures, you don't need that. It's for day trading stocks. You don't need it for swing trading. You do need it if you're buying and selling the same day. So it's a minimum 25 technically, and realistically you want to put 30 in there. That's correct. Okay. Other questions about things in general or about my presentation here? Um, this Saturday I am teaching a class. This one you have to pay for. You may have multiple trades. Yeah, well, Patrick, those are rules. I see what you're saying. I thought that's what you're getting at. You need to set your rules, Patrick, in terms of the total goals for the day and risk and what you're willing to lose in a day. That's correct. And yes, I have preached that. I mean, it depends how many you want to lose a day. That's really a personal rule, Patrick. I mean, if you're willing to lose 3 a day and you want to start the day with 3 trades and then be done in 10 minutes, I mean, you could do that, I suppose. It's up to you. But the important thing is that you have a limit, like I did today. It's the first time I had to do it in months. But I decided today my trade that I would bet my life on didn't work, and then I took 2 shots at the thing, and I say, you know what? I'm just done. I could sit here and I could get it back. I could sit here and get frustrated. And it's a rule. The reason you have rules is you follow them. It's not because maybe you could have made it back. It's because, you know what? I know I'm not in a good situation now. I know I make money every day. One day losing a couple, who cares? Not a big deal. You don't want to turn it into a bad thing. And as I said, tomorrow my rule is I'm not going to trade before 10 o'clock. Just because everybody has that little psychological issue that you want to get it back. So I'm going to be, shut down till 10, and then I'll be back to normal. That's just what I do. And I think they're good rules to follow because I've been doing this a long time. I do not get into endorsing brokers at all, Fred, because the reasons I have them have nothing to do with why you may have them, and it's all a very personal thing in terms of how much you trade, how many shares. Do you want all or nothing share trading? Do you want per share trading? Do you short a lot? I think just research it, go into a chat room, research it on the internet. It's all, I think, a personal decision. There's nobody I would just understand. If chart packages, if you like certain charts, you can't get them at every broker, that type of thing. All right. So I am, I am told I'm the worst salesperson in the world, which I take as a compliment, I guess. But I am never having sales or anything like that. Um, I have started my class prices at $12.50. I think they should be $14.50, but I'm leaving them here for about 6 months. All 3 are 3,000. I have 3 classes that I think teach everything that I know that I would want to relate to somebody to know how to make money in the market. There's class 1, 2, and 3. Class 1 is mastering technical analysis. Class 2 is mastering advanced tactics. I taught those 2 the last 2 weeks, and then this one coming up is mastering gaps. Mastering gaps does not have a prerequisite. Anybody who wants to can take it. If you've taken stuff from me before, you can email me. You could qualify for just the retake rate, but I'd have to talk to you about that. And I'm teaching them every 6 weeks. So it's 3 weeks of class, 3 weeks off, 3 weeks of class. You get unlimited retakes when you sign up. I'm here to try and help you learn how to make money, period. They're very reasonable price classes. This gap class, I know a place that has it for 4 times the price, and it's a cheap derivative of my class. So as you know, I wrote a lot of this stuff. For those of you who don't know me, I'm very good at teaching it. And I think repetitiveness is necessary. So you need to get in there and take the class, put it to practice with some very light shares or paper trading, take the class again and really understand it. So I'm here to really try and help people that want to learn. You can send me trades, trading plan if you take a class from me. I encourage you, if you are ever in a trading room, to check out my room. I think you would like it, unless you like doing 30 trades a day, then you'd be bored out of your mind. Questions? Do you have rules regarding spread size? Well, yeah, absolutely happy, but it's relative to. See, it's very hard to put that in. I don't have that as a hard rule. I have it as an intuitive rule, because it's not just spread size that matters. It's a whole formula of being able to enter a stock with the share size you need. It involves not only the initial spread you see. See, Happy, you can see a stock with a 4-cent spread, but then when it moves, it jumps to a 20-cent spread. Right? So it's not just the spread that you see, it's the depth, it's the liquidity, it's how it reacts when it moves, and the overall volume it does. So it's a lot of things. And it also then depends on what is your entry compared to your target. In other words, today when I was messing with Red Hat, I knew it was going to be a 10, 15 cent price to get in and out. But I'm looking at $3 and $4 targets on an 80-cent stop, so I didn't care. It all worked into the formula. So all those things you have to consider. You may say I don't want to pay 3 cent slippage, but if you're going for an 80-cent move with a 10-cent stop, we don't care about 3 cent slippage. So it's a bigger formula, and it's something you have to kind of work out. I can't give you an exact number. Naturally, it's nice to trade with almost no spread or with no slippage is really. And by the way, guys, I'm going to have some stuff on the site soon. I've been promising. I do have some YouTube videos up on my YouTube site. I'm going to put them on my website as well, so you can access them either way. And I've been promising, but I just got a little behind with some stuff of doing a lot of free videos for people on things like slippage and about a whole lot of different topics that people want to hear about. Just quick little 5-minute videos. And slippage is definitely one of them, because I've kind of tried to make a career out of not having a lot of slippage, because that is just wasted money. If you're trading gaps, sometimes you don't have much of a choice. You either play or you don't. But the rest of the time, the way I enter things, I do with virtually no slippage all the time. Okay? Our class is a prerequisite. No, Paul. You may join the room. There's no prerequisite. You just join. It's $147 a month right now. The price goes up when we hit a certain number of people. I have incremental pricing that at certain levels the price will go up as more people join. I want to contain the room to like less than 100 people price-wise. So I'm doing that but it's at 147 right now. I don't expect it to go up for the next, 2-3 weeks at least. So, okay. Can one trade in a 401 account? There's a lot of different rules for your 401ks, Paul. You got to check with your brokers on that. I'm not really an expert at that because I don't do it in mine. I know there's some people that have brokers that actually can even shorten their 401k account, and naturally anybody can if you use the market inverse ETFs. But as far as activity, you have to check with your individual brokers. Okay. Yeah, Paul, it's funny. I wrote a note to myself here to check the link. I don't think the link on my website is actually pointed toward my YouTube site because I had some trouble with YouTube initially. But if you go to YouTube and you type in search discipline trading strategies, you will find me there, one of the top few. I'm getting enough hits now. I've had several hundred people look at the few things I do have out there. So if you go there and type in the name of the discipline trading strategies, you'll get there. And by tonight, I'll make sure that the link on the website is hooked up to there, because I don't think it points there right now. I don't think it ever pointed there. And for those of you that were at a prior event I did, I apologize. The YouTube actually, for some reason, they banned the first video I put on my site. And I don't know, so they complained about it. Finally, they removed the ban, and some people who asked for the videos, I didn't send them because I couldn't. Apparently, that was lifted a week ago. I didn't even know it. So they've been on YouTube. I haven't emailed to people who've asked. I will do that, but YouTube is up and going with the stuff I've on. There's some Trade of the Weeks, 3 webinars I've done so far, and I'm going to load it up with a lot of new person type videos as well too very soon. Okay. Pristine references for what? When you type what, Paul? I was going to ask the same. Didn't see. Yeah, I think the icons there, CA, but I don't think it goes anywhere because I didn't want to hook it up because the site wasn't functioning properly. But it is now, so I'll make sure it's all set. Where did you get pristine references, Paul? From clicking on YouTube? Oh yeah, well if you type my name, it's still gonna be dominated probably by pristine because I was there most of the time over 17 years. So yeah, but put discipline trading strategies. Don't put my name. Put discipline trading strategies. Yeah, discipline trader I think is actually the name of another group. Discipline trading. There you go. Or we could just have somebody really smart like Gino just put the stupid link right there, and then we don't have to worry about it like I should have done a half hour ago. Thanks, Gino. Hey, Harold. And again, guys, like I said, I'm done. I'll sit here and answer questions until 25 minutes. I want to eat dinner, but how's that? Why do you not include ETFs in your universe? Because Harold, I want to look at new stock symbols. ETFs. If you put all the ETFs in there, you're going to be looking at about 30 or 40 different ways to look at the market. There's the Qs and the SPY. There's the double Qs and the double SPY. The triple Qs, the triple SPY. The negative triple Qs. You know what I mean? So you're looking at the same thing over and over and over again. I want to look at the market, I'll look at the market. I want to look at 1,000 stocks, I'll look at 1,000 stocks. I don't want to be confused by having the ETFs. So Harold, I go through and look at sectors, I look at the market. Okay, I understand sectors, I understand the market. Now show me stocks. I don't want to get, if you leave those in there, there are 400 or 500 ETFs right now. And if you're using just a volume classification, you're probably looking at 50, 60, 70 ETFs in your list. So I don't want them there. I'll look at them when I want to look at them. Does that make sense? Hopefully you put the right link out there, Gene. Other questions, anything? The site is, just disciplinedtradingstrategies.com. Let me type that in here. Just go there and check it out. By the way, if you think some of you may want to get a little different take on something, go to my website and read the homepage down lower. Anybody ever read that? If you think I'm trying to dump a seminar on you or something, I'm here to try and help people. You read the bottom part of my webpage and you tell me if you think I'm trying to talk you into taking a seminar. It's called Warning. That's what its section's titled, down at the bottom of the homepage. It's called Warning. Oh, that's not it. That's ignore that. That's not. Here it is. Yeah, next one, guys. I haven't decided the next topic. It'll probably be 2 weeks. Thanks, HR. And yeah, I have a whole slew of topics. I mean, I could go a year without repeating them probably. So we'll do some different topics next time. I kind of wanted, in all honesty, I kind of want to do this one on shock value because it ties in nicely to gaps. So somebody who's impressed by the shock value could say, hey, gap class Saturday, I'll be there. See, that's called salesmanship. I'm a good salesperson. Selling the gap class by talking about shock value the week before. Isn't that good? I did that right? Did I do that good? I see some people typing, so I'll hang here a minute and see what you got to say. Thanks, Davis. We'll see a lot of you guys in the room tomorrow. I see some of the room people are here. Hey, everybody. You guys all know this stuff already. All right, I think we are out of questions. Everybody saying good night, right? 5, 4, 3, 2, 1. All right, guys, thanks a lot. Again, if you got this invite, you're on the master list of DTS. You don't need to sign up for every one of these. So when you see the next one, you don't need to sign up. I automatically send an invite to people, and if you're here, you're on the list. I send that to a big group so people who are not on the free DTS list will sign up on the DTS list to get on it. So if you're here, you'll always be invited unless you decide to say goodbye. Thanks, guys. Take care. Have a great evening. We'll see some of you guys tomorrow in the room. 9 o'clock. Be there.